So you're an Australian who's bought some crypto. Congrats. Chances are you've done really well over the last couple of years. But if you've hit the point where you need to start selling some of that crypto, you need to ask yourself the question, how is cryptocurrency taxed? Well, in this video, I'm going to break down exactly how cryptocurrencies are taxed here in Australia, and a tool you can use to solve all of these problems in a single click. So what exactly is cryptocurrency tax here in Australia? Well, cryptocurrency is treated very differently to how a normal currency is taxed. It's more similar to how stocks are taxed, and that's because cryptocurrency by the ATO is treated as property rather than a currency. This means there's going to be several particular events that happen which trigger a capital gains tax or CGT event that you need to be very aware of when you're making trades. And we're also going to discuss how crypto income like staking, airdrops, and other sources of income are treated by the ATO. So let's cover some of the most common capital gains tax or CGT events that happen with crypto. The obvious one is every time you sell some crypto for a fiat currency, that is a CGT event. So if we bought one Bitcoin back in the day and then we've held it for a long period of time, no tax events happened yet. When we sell that Bitcoin for Australian dollars, that is a CGT event, just like it would be with a stock, and you have to calculate whether you've made a gain or loss on that and file that accordingly. The second most common CGT event, and this one trips people up all the time, is when you trade one coin for another. So if we swap some of our Bitcoin for some Ethereum, there's a CGT event in there because we technically disposed of some of the Bitcoin to buy the Ethereum. So that disposal is what triggers a CGT event, and you need to file that as a gain or loss, depending on if it was a gain or loss, to the ATO. Now there's a tricky one in there that's inside a few different transactions, and that is the crypto fee. So if you do a wallet transfer from your own exchange account to a wallet, often you'll pay a transaction fee in the cryptocurrency that you're transferring. So if we're transferring some Ethereum from our exchange to a wallet, you'll often pay a little fee in Ethereum. That disposal is also counted as a capital gains tax event. So when you're shifting it between wallets, you need to keep that in mind. It'll be a very small capital gain or loss, but it's still something that unfortunately needs to be recorded and filed to the ATO. The next most important tax event is around staking income. Now, staking has become super popular over the last couple of years as things like Ethereum now offer staking rewards. But with that comes a really big tax admin burden that you as the investor have to sort out yourself. So let's say we've staked a whole stack of Ethereum and we're receiving a new 1 Ethereum every single day as a staking reward. How the ATO want to treat that is even though you're receiving 1 Ethereum, they want you to calculate what the Australian dollar value is of that, and that's what you file to the ATO as taxable income. So even though you haven't received actual cash, it is treated as if you had. Now this can get you into a bit of trouble if the price of Ethereum rapidly drops, because it means later when you go to pay tax, even if you wanted to sell that staking reward, you'd sell it for a lot less than what you actually have to file to the ATO. Another key crypto transaction is airdrops. Now these are taxed very similarly to how staking rewards are taxed, but the difference is with staking you already own that holding and are receiving more quantity. With an airdrop, you're receiving that a new holding potentially out of thin air that you don't currently own. But the tax treatment is the same. So if we were airdropped 1 Ethereum, we would have to calculate what the Australian dollar value is on the day we received it, and that is counted as ordinary income that we have to file to the ATO. That also opens up a new Ethereum position, that 1 coin that we received. That dollar value forms your cost base, so in the future if we go to sell that airdrop reward, we can calculate whether it was a capital gain or capital loss. Let's look at crypto to crypto transactions a bit more closely. Now, as I mentioned earlier in the video, there is a capital gains tax event in there, but we have to be very careful when we're doing a coin-to-coin swap, because not only is there a CGT event on the coin you're trading, remember there's also a CGT event on the fee that you pay during the transaction. So if we were trading Bitcoin for Ethereum, we would have to pay some capital gains tax on the actual Bitcoin that we're trading, and potentially the fee is paid in Ethereum. So we would also have to pay capital gains tax there as well. So It's really important that when you're doing coin swaps, you do it deliberately with the tax implication in mind, because at Navexa, we see hundreds and thousands of investors doing lots and lots of coin swaps, thinking that there's no downside to doing that other than doing the trade, but in fact you're racking up all these taxable transactions that you're going to have to file. And often that means people will have to sell crypto to pay for that tax burden. Now, one other aspect which is a bit of a grey area is using crypto to purchase goods and services. Now, if you check out the ATO website, there's a very slim definition where you can have crypto treated as an actual currency that you use to pay for something. Because after all, when we buy something with Australian dollars, we don't trigger a capital gains tax event on the Australian dollar, right? So the same thing is true with crypto, but you need to be able to prove that you originally bought the crypto for personal use, rather than buying the crypto as an investment and then later using it for personal use. So generally the rule of thumb is that anytime you swap crypto from your name into someone else's name, it's usually a CGT event, because it's pretty much always the fact that you bought it as an investment. But if you can prove that, no, today I bought 1 Bitcoin and immediately traded that Bitcoin to buy a car, you could have an argument there that that was a personal use situation and there's not actually a CGT event on the disposal of that Bitcoin, purely because you were using it as a currency. You bought some and immediately bought something else with it. One more advanced area of tax, and this is true across cryptocurrencies and stocks, is tax loss harvesting. So you can use tax loss harvesting to use some of your crypto losses to offset some of your crypto gains. So if you sold, say, some Bitcoin and made an $1,000 capital gain, you're able to negate that gain by selling something at a loss for $1,000. And then that loss completely negates the gain and your tax bill becomes zero. But many investors fail to use tax loss harvesting because it's actually quite tricky if you're not tracking things properly, which leads me into one of the most important things with crypto and stocks and investing in general, and that's keeping accurate records. So without having detailed records of every buy you did, every sell you did, every crypto to crypto trade you did, all the staking rewards that you've received, airdrops, mining rewards, all of these things need to be meticulously recorded, and then it allows you to do interesting things like tax loss harvesting. Because after all, you can't do tax loss harvesting if you don't know what your current taxable position is. It's also extremely important that if the ATO ever come and audit you, that you can produce the records. Now this gets really tricky when you've been, say, staking a coin and receiving a staking reward every single day. That's 365 transactions a year you need to keep track of. And that assumes you only staked 1 coin. Imagine if we had staked 5 coins or 10 coins, and we now have 3,600 something transactions in just staking rewards alone that we've had to calculate the dollar value on every single one of those so that we can file our tax correctly. It becomes a bit of a nightmare. The good thing is there a tool that can sort all this out for you, and that's why I founded the company Navexa, which is a performance tracking and tax reporting platform built for Australian investors. Now, not only do we handle all the crypto events that we've discussed in this video, we also do full tax reporting across stocks as well. So if you own stocks and cryptocurrency, it means you can do your tax reporting in the one place and also use losses from one of those to offset gains from another. So you might be able to use losses from crypto to offset gains from stocks and vice versa. And that is the power of having everything in the one place. Now, you can sign up to Navexa free for 14 days to trial it out. We have integrations with all the main crypto providers here in Australia like CoinSpot, BTC Market, SwiftX, and you can input your transactions and generate tax reports really quickly. Not only that, is you can do it across multiple entities, so not just your personal entity. If you have a company or an SMSF or your partners, you can do it all in the one place. So check out the link in the description for that.